Welcome to the Deep Dive, where we take a stack of your sources, articles, research your own notes, and extract the most important nuggets of knowledge and insight just for you. I'm John.
And I'm Wendy. We're both staff here at WeWire, and we're excited to bring you a special deep dive from our weekly Stay Wired recap.
And what we're diving into today is, well, it's truly fascinating. Get this. Meanwhile, across sub-Saharan Africa, cryptocurrency adoption surged over 45% year-on-year between 2023, and 2024.
Wow, 45%.
Yeah, and what's even more striking is that Nigeria alone accounted for approximately 40% of regional stablecoin inflows. This really underscores how critical these informal networks have become.
That's exactly right. So our mission today really is to unpack how these informal networks have essentially become, well, what we're calling unofficial central banks of WhatsApp in West Africa.
Unofficial central banks of WhatsApp. Quite a title.
It is, isn't it? And we want to explore what that actually means for everyday people, look at the surprising facts our Stay Wired report uncovered, and the broader financial landscape that's, well, it's rapidly being reshaped. This isn't just about crypto. It's like a quiet revolution in how money actually moves for millions.
Okay, so let's unpack this then. Our report highlights this phenomena of informal peer-to-peer, P2P, foreign exchange networks that are, well, they're rapidly gaining ground.
Right.
We're talking about platforms like WhatsApp, Telegram, even the P2P features on crypto exchanges like Binance. These are increasingly supplanting the traditional official banking channels for currency trades.
So not just niche stuff.
No, not at all. This isn't just a niche market. It's happening at the retail level and, importantly, for small to medium-sized enterprises, SMEs, across Africa. It's a seismic shift, isn't it?
It absolutely is. And what's fascinating here, I think, is the sheer scale and the function of these networks. When we say unofficial central banks, it's not hyperbole. Yeah, our data shows that these dense, trust-based local networks now often handle more USDT liquidity daily. That's Tether, the stablecoin.
The one pegged to the dollar. Right.
Exactly. Pegged one-to-one with the US dollar. So they're handling more of this digital dollar liquidity daily than traditional central bank mechanisms. Just think about that.
More than central banks. Wow.
Yeah. So these informal networks are effectively managing more dollar flow than the official institutions in certain contexts. They're acting as a de facto market maker, setting prices, managing access to hard currency, and responding really swiftly to economic shocks.
Much like a central bank should do, perhaps.
Well, yes, but operating entirely outside any formal channels or regulatory oversight. Completely off the book, so to speak.
That's a profound statement.
Yeah.
More dollar flow than traditional central banks in some areas. So how does this actually play out on the ground? Can you give us some specific examples from the report? Like, what does it look like?
Absolutely. The report paints a very vivid picture. Across major cities, think Lagos in Nigeria, Nairobi in Kenya, Accra in Ghana, these top-tier WhatsApp-based vendors, they're coordinating trades worth millions of dollars in USDT for local currencies every week.
Millions. Weekly. On WhatsApp.
Millions weekly, yes. These aren't just small, isolated transactions. These vendors are, well, they're sophisticated operators. They're the ones determining the spreads. The difference between the buying and selling price, that's their profit.
Right, the margin.
Exactly. And more critically, they're rationing dollar liquidity when it's scarce. And they can even shift exchange rates for local currencies within hours of major policy announcements or, unexpected economic shocks.
Hours. That's incredibly fast.
Imagine the agility needed for that. A central bank might take days, maybe weeks to react through official channels, but these networks, they can pivot almost instantly.
So what makes WhatsApp specifically such a powerful tool here? It still seems a bit counterintuitive, for such significant financial stuff happening on a messaging app.
It's an excellent question, and the why behind WhatsApp's success is, well, it's quite telling about the underlying needs. First, you've got near ubiquitous smartphone penetration, particularly in Nigeria and wider West Africa. So WhatsApp is just there. It's accessible for almost everyone.
Okay, the tech is there.
But beyond the tech, the crucial part is trust. Not formal credentials, not government IDs, but trust. In an environment where, let's face it, traditional banks might have really cumbersome know your customer KYC requirements, or they might just be inaccessible for many small merchants or individuals.
Yeah, their hurdles can be high.
Exactly. So these informal networks, they thrive on personal referrals, on community reputation, on demonstrated reliability over time. You build trust by consistently delivering, by being known in your community. This sort of human-centric informal trust network becomes the backbone of finance when the formal systems fall short. It's really a testament to human ingenuity, finding ways to bridge critical gaps.
Okay, here's where it gets, for me, really interesting. When you contrast these informal networks with the traditional central banks, I mean, central banks routinely deploy billions, right? Billions of dollars, often from national reserves, trying to defend their national currencies against devaluation.
Huge sums,
Yet
yes.
our report points out that a single, well-connected WhatsApp vendor, leveraging a network of maybe thousands of contacts, can effectively shift the street exchange rates more swiftly than those official channels with all their billions. It's almost mind-boggling when you think about the asymmetry there.
It really is, and it speaks volumes about the agility and the decentralized nature of these informal systems. Think about it. A central bank operates with layers of bureaucracy, regulatory frameworks, slower decision-making processes.
Lots of meetings.
Right, lots of meetings. Whereas these WhatsApp vendors, they benefit from incredibly low overhead, direct access to capital, often just from their own networks or immediate profits, and they have these real-time direct market feedback loops
They hear what's happening instantly.
instantly. They don't have to wait for policy meetings or official announcements. They respond to the pulse of the market, like right now. This lets them adjust their rates, their spreads, manage their liquidity positions in hours, sometimes minutes. That just far outpaces the often more ponderous official mechanisms designed to defend, say, the Nigerian Naira or the Ghanaian cedi.
And that rapid responsiveness, that's the key draw, isn't it?
Absolutely. That's precisely what makes them so attractive and, frankly, so powerful for people who need quick access to foreign currency, which is a lot of people in these economies.
Okay, so if we connect this to the bigger picture, the implications seem profound, especially for what economists call monetary sovereignty. Could you elaborate on that? Why does this informal shift matter so much for national economies and, well, the central banks themselves?
Certainly. It's a huge issue as regulated foreign exchange FX markets shrink because, more and more transactions are just moving over to these informal channels.
They're being bypassed.
They're being bypassed. And these networks, they don't just stay local, they scale globally, connecting diasporas, traders across borders. This erosion of the traditional FX markets, it significantly reduces policy efficacy. It basically makes government financial policies less effective. And it directly challenges a nation's monetary sovereignty, its fundamental ability to control its own currency and financial system.
So how does that loss of control actually manifest?
Well, when a significant volume of FX transactions moves into these decentralized informal liquidity hubs, central banks risk losing control over key monetary tools. Think about open market operations, for instance, buying or selling government bonds to influence the money supply. That becomes less impactful if a big chunk of the money is flowing elsewhere. And similarly, inflation targeting a central bank's goal of keeping prices stable and predictable, that becomes incredibly difficult to enforce when a large part of the money supply, and crucially the exchange rate people actually use, is determined by these external unregulated forces. Essentially, they lose their grip on maintaining currency stability. And that can have really serious cascading effects on the entire economy. Imports, exports, inflation, everything.
It sounds like a classic dual-natured phenomenon, doesn't it? On one side, you have these really severe challenges to monetary policy and national control.
Major headaches for policymakers.
Right. But on the other hand, for the people on the ground, for the SMEs, these informal systems are clearly providing something vital that the official channels aren't delivering.
Right.
So who really benefits when these unofficial central banks of WhatsApp take hold? It's complex.
That's precisely the central tension. You've hit it exactly. While the central banks are grappling with these, growing challenges to their authority and economic stability, for small and medium-sized enterprises, which, let's remember, are the backbone of many African economies, these P2P WhatsApp central banks are often the only accessible providers of dollar liquidity.
The only option sometimes.
Often, yeah. Imagine a small importer in Accra. They need dollars, maybe just a few thousand, to buy raw materials from overseas. They might face really restrictive limits at the bank, or long queues, or frankly, uncompetitive rates if they can even get access.
Right.
So turning to a trusted WhatsApp vendor, That provides a lifeline. It ensures they can actually continue their business operations. So while these networks absolutely create policy headaches, they are at the same time bridging critical systemic gaps. They're providing a vital service where formal systems are falling short.
Yeah.
It's market demand finding a way, even if it's an unconventional, unregulated way.
So given this really complex and clearly evolving landscape, what does this all mean for the future? I mean, are there formal solutions? Are there innovations aiming to address these structural gaps and maybe bring some of this activity back into more regulated channels?
Yeah, this raises a profoundly important question, doesn't it? How can the formal systems adapt and maybe reclaim some of this ground, or at least integrate it better? One really significant development our report highlights is the Pan-African Payments and Settlement System, or PPSS.
PGSS, okay.
Yeah, PPSS. It's gearing up to launch its Africa currency marketplace, hopefully in 2025. Now, this is supported by, I believe, 15 central banks already, and the aim is to enable direct currency swaps across borders, right on the continent.
So bypassing the dollar.
Exactly. Imagine a user in Nigeria being able to exchange their naira directly for someone needing birr, the Ethiopian currency, for instance, without having to first buy US dollars as an intermediary.
That could be huge for intra-African trade.
Absolutely. It's a direct response to the dollar dependency we see fueling these informal markets. The goal is to streamline inter-African trade and finance, make it cheaper, make it faster. It's an ambitious project, for sure, but one with enormous potential to create efficiency within the formal system.
Okay, that's interesting on the formal side, but we keep hearing about stablecoins like USDT playing a big role here. You mentioned them right at the start with that big surge in Nigeria.
Yeah.
How do they fit into these formal solutions, or are they just part of the problem for central banks?
Stablecoins. Yes, like USDT and USDC. That's USD coin, another big one pegged to the dollar. They're a really fascinating part of this whole puzzle. They're gaining significant traction, as that statistic showed, because they offer Africans a relatively stable hedge against the volatility of many local currencies and those persistent foreign exchange shortages we talked about.
So a safe haven,
Right.
essentially.
Kind of, yeah. What's really crucial to understand is their real-world utility goes way beyond just speculative crypto trading, which is how some people still think of them. For many people, they are serving as essential value storage, protecting savings from rapid inflation. They act as hedging tools against local currency fluctuations. And increasingly, they're crucial cross-border transaction mediums, maybe for remittances from family abroad or for business
That's
payments.
a real utility.
Real utility. They offer a predictability and an access to a stable currency proxy, the dollar, that many local currencies simply cannot provide consistently. Now, the challenge for policymakers, of course, is how do you integrate these popular tools into a regulated framework, rather than just trying to battle them outright? That's the big question.
So pulling it all together then, we're seeing this really fascinating complex landscape. You've got these informal FX networks, largely running on platforms like WhatsApp, and you've got the increasing adoption of stablecoins. And together they seem to be rapidly displacing the official market-making channels, especially in regions where local currency liquidity is maybe a bit shallow.
That sums it up well.
And this undoubtedly empowers SMEs, right? It provides them with essential services, bridges those critical systemic gaps we discussed.
Definitely. But as we've thoroughly discussed, this also undercuts the effectiveness of traditional monetary policy and, challenges the very notion of monetary sovereignty for these nations.
So the path forward.
Well, the path forward, as our report suggests, probably isn't about ignoring these informal systems, pretending they don't exist. Instead, it likely lies in developing robust formal infrastructure solutions like PAPSS, Africa Currency Marketplace, alongside potentially regulated stablecoin systems. Finding ways to bring the benefits into the light.
So harness the innovation.
Exactly. These could present a clear way towards scaling efficiency and accessibility, while, and this is the crucial part, for governments creating mechanisms that could help preserve policy control for central banks. It's a really delicate balancing act. Innovation versus control, inclusion versus regulation.
Yeah. Understanding this evolving landscape is, well, it's absolutely vital, isn't it? For citizens, for policymakers, for businesses operating in these regions,
Yeah.
or even globally, really. It just underscores this ongoing tension and evolution in how money moves in the digital age. It's a conversation that is far, far from over.
Absolutely. Is this a temporary workaround born of necessity, or is it a fundamental reshaping of how global finance will operate in some regions, forcing traditional institutions to adapt much faster or, risk becoming obsolete?
That's definitely something for all of us to consider. This has been a deep dive looking into insights from the weekly Stay Wired recap. Now, we usually transition to the investment ideas section from the recap here.
That's right. And just a reminder, this next part is purely for informational purposes only.
Okay, so briefly, the most active stocks mentioned in this week's report included NVIDIA Corporation, NVDA, NIO Inc., NIO, SoFi Technologies Inc., LSFEI, Lucid Group, Inc., LCID, American Airlines AAL, Apple Inc., AAPL, and Tesla Inc., TSLA. The report included their last price, change, average rating, and sector, but obviously that data changes rapidly.
And here's the crucial disclaimer. The information provided is for informational purposes only and should not be considered as financial advice. Stock prices, ratings, and other metrics are subject to change based on market conditions. Always perform your own research or consult with a qualified financial advisor before making any investment decisions. And remember, past performance is not indicative of future results.
Absolutely essential to keep that in mind. Thanks so much for joining us for this deep dive into the Stay Wired recap.
We really appreciate you tuning in and joining us on this exploration.
I'm John.
And I'm Wendy.
And we're staff at WeWire. We'll catch you next time.
Stay Wired Weekly Recap was produced by WeWire,
a B2B company, bridging the banking gap between emerging markets and the world.
Tune in same time next week for the Stay Wired Weekly Recap.